Hello everyone, welcome to my YouTube channel Voice of Commerce. Today's topic which I am going to discuss is Introduction to Income Tax. Stay tuned until the end. I am going to give you the MCQ questions which you can expect in your upcoming examinations, as well as the short and long answers questions also for the examinations which you are going to attend. First, let us discuss the history of income tax. What the income tax at all, how it has evolved in India. Let us come to income tax. We know that income tax is a tax on income. Means if any person earn income in India, he or she supposed to pay income tax based on their income earned limit. So it has been the income, we know that it has been earned since the unmemorable back towards the ancient Hindu period. Everyone is earning the income. But who introduced the income tax for the first time in India? So it was introduced by Sir James Wilson in India in the year of 1860. So why he has introduced the income tax? He has introduced the income tax to recover the losses due to the military mutiny of 1857. It is also called as a first war of Indian independence. Maybe how you can recall the movie called Mangal Pandey. In that movie, there is a military mutiny. The history as a background is there. So to recover the losses of that, they introduced the tax introduced in India by Sir James Wilson in the 1860. So since 1860, there are the many amendments and changes has brought forward in the Act, and the bill was passed in the Parliament since in September 1961. So it was presented and introduced in the Parliament in the April 1961. So that's why this act came into force on 1st April 1962. That's why we call it as Income Tax Act of 1961, and Income Tax Act came into force on 1st April 1962. So the entire act was divided into 298 sections, and the subsections ran 100 and more. So act applies to whole India including Jammu and Kashmir. Next is meaning of tax. So tax is a levy imposed on the individual by an appropriate authority. So in India, the appropriate authority is central government. So it is a form of revenue to the government. Obviously, it's a revenue. The government will collect the tax and it will spend for different developmental activities in the country. So types of taxes. So coming to the types of taxes, we have two types of tax. One is a direct tax, another is the indirect tax. What the direct tax is? So it is simple. The person on whom the tax is imposed, the same person has to pay the that burden, has to pay the tax. So the incidence and impact falls on the same person. Example, income tax, property tax, etc. Who has an income, he has to pay the tax. Who has a property, he has to pay the tax. It will not pass on to another person. But the indirect tax is different. What will happen in the indirect taxes? Here the incidence and impact falls on the different person. Take example like a manufacturer and a customer. For example, a toothbrush manufacturer manufacture toothbrush, and he will pay a little bit tax when he is manufacturing, but the ultimate burden fall onto the end user. The end user is a customer who uses a toothbrush. He has to pay the final tax. So example, indirect taxes like excise duty, custom duty, goods and service tax, etc. are the examples of the direct indirect taxes. Difference between direct tax and indirect tax. So let us discuss one by one. Direct tax, in that the taxes are levied based on the income or receipts, are called as direct taxes. So whatever you earn, based on that you have to pay the tax. That is nothing but a direct tax. So coming to the indirect taxes, which are levied on expenditure, are called as indirect taxes. How much you spend, based on it you need to pay the indirect taxes. And it is a tax on a person. Direct tax is a tax on a person, means how much, what is your income, based on that you need to pay the direct tax. But indirect tax, it is a tax on a commodity. So what commodity you purchase, what is the rate of tax on that, you have to pay the tax on that. Next, the person paying the tax has to bear the burden. Means same as I discussed in the earlier about the meaning of direct indirect taxes. The burden will not transfer to another person in the direct tax, but in indirect taxes the burden will transfer to the end user who consumes the goods. He has to pay the tax at the end, full tax at the end. Next, direct tax is considered as an effective and important tool of anti-inflationary fiscal policy. What it is? Anti-inflationary fiscal policy is nothing but, say for example, here higher the income earner has to pay the highest tax in the country. So what will happen? It will avoid the inflation in the market. What will happen? Suppose for example, if a person earn 15 lakh rupees, then he will come under the higher tax slab. So what the government will collect the more tax from him, and it will create the inflation, anti-inflation. It will create the less inflation in the market. So he has to pay the high tax, then his income level will come down by paying the highest tax. But indirect taxes prove to be inflationary as they increase the price of the commodity by the amount of tax levied. What happens when the price of commodity increases, the tax rate is also going to be increases. So suppose for example the X commodity price is 100 rupee and tax rate is 10% or 12%, then it will become 112 total with tax. But if the the commodity value will be increased to 120, then automatically on that 12% tax will be increased on the value. So that's why it's an inflationary in the, it creates a value of the commodity more in the market, it creates the inflation in the market. And lastly, direct tax is a progressive in nature. It's a progressive in nature. It's keep on, when you earn money, you have to pay more. So indirect tax is a regressive in nature. It is a regressive. It will regressively collect the taxes and it will make the person to pay the tax based on their expenditure, based on their spendings. So next, very important, principles are canons of taxation. So this is important to our country. Who propounded this canons of taxation? So we all know Adam Smith is a father of economics. In order to look into the welfare of the state, he told that simply you need not to collect a tax, same tax from each and everyone. You have to collect a tax based on their income. That is, the rich are made to pay the tax more and the poor is taxed less. That is, the equilibrium is maintained in the society. You have to maintain the equilibrium in the society. Everyone is not same. Suppose for example, if you earn 100 rupee, you have to pay 10 rupees tax, means it is not good. So you have to collect a tax based on their earning capacity. So Adam Smith has given different canons of taxation. The important canons of taxations are, let us discuss one by one. One is a canon of equality or ability. What the canon of equality or ability is about? So the tax should be levied based on the people's ability to pay. So whether X person is able to pay the same tax and Y person is also able to pay the same tax, that should be considered. So we have to collect the tax based on their ability to pay the tax. How the ability will come? Based on their income capacity. That is, an income tax system where the higher earners pay the more tax. That is a progressive in the nature. And the next is the canon of certainty. So coming to the canon of certainty, the taxpayer should know how much, when and how to pay the tax. It's a certainly they should know about that, and no confusion of charges. So there should be no confusion. They should clearly know what is happening, how much they are collecting. So example, income tax directed source, that is TDS they will do. So it is a fixed and known in advance. Everyone know how much TDS is going for my income. Next is a canon of convenience. Coming to the canon of convenience, tax should be collected in the manner and time of convenient for the taxpayer. Means, say for example, so next year I am earning the money, this year only I have to pay the tax before earning. That is not like that. That should be convenient in the nature. So what that example, the income tax is collected after the financial year when the people have calculated their earnings. That will be collected. Finally, when you are filing your income tax, they will tell finally how much you need to pay. That is going to be considered. Next, canon of economy. Coming to the canon of economy, what the canon of economy talks about. So the cost of collecting the tax should be minimal and compared to the revenue collected. So it should be minimal. It should be minimal in the nature when you compare to the revenue collected. And example, online GST filing reduce the paperwork and collection cost. So paperwork it will reduce and collection cost also it is going to be reduced. Next is canon of productivity. Coming to the canon of productivity, what the productivity talks about. So here a good tax should generate adequate revenue for the government. It should render the adequate revenue to the government when the good tax system is there. So what in the sense? Example, GST is highly productive as it is brings in the large share of India's tax revenue. So large share of India's tax revenue has been bring from the GST. Next is the canon of elasticity. So coming to the canon of elasticity, the tax system should allow the government to increase revenue easily when need, like during the war or disaster. So when it is needed, the government should elastically collect the tax. So example, increasing the excise duty on petrol, diesel during the crisis period. Every government will do that based on their requirement. And the next is a canon of simplicity and flexibility. So coming to the simplicity and flexibility, so the tax laws should be easy to understand. The people, a common man can understand the tax laws and adaptable to the changing conditions. Everyone should be adaptable to the changing conditions. Say for example, a new tax regime and old tax regime. The people are understanding that people are easily adopting the changes as per their requirement. Example, GST replaced multiple indirect taxes with one simple tax structure. That is also one of the example we can take. And lastly, canon of coordination. Coming to the canon of coordination, there should be a harmony between the central and state government to avoid the double tax and conflicts. So there should be harmony. See, for example, both the people are collecting the same tax, then it will become a cascading effect, a tax on tax. That should not be there. So example, GST Council coordinate the tax between the union and state, avoid the overlapping of the VAT, service tax and etc. So this is what the Adam Smith has given a very good principles or canons of taxation to the country like India, because we have a rich, poor, middle class. Based on their earnings, the taxation system should be there. That is very important, the principles or canons of taxation which given by the Adam Smith. Let's move on to the legal enactments governing the income tax in India. So what are the legal acts we have in income tax in India? The very important is Income Tax Act of 1961. It is an act to levy, administer, collect and recover income tax in India. So it will not only levy, it will administer, it will keep on collecting the taxes and recover the income tax in India. So the Acts is effective from 1st April 1962. So I told you in the beginning itself, the Income Tax Act came into force from 1st April 1962, but Income Tax Act is from 1961. So that is, it consisting of 298 sections and 14 schedules. This is very important. This is consisting of 298 sections and 14 schedules. So what the act will do? The act helps determine a taxpayer taxable income. How much is your taxable income? That will be determined to the act. Tax liability, how much tax you need to pay. Appeals, for example, if you want to appeal something about the income tax authority or appellate tribunal, you can go to the court of law. Penalties, they will put penalties on the people who has not paid the taxes, and prosecutions, etc. All this will done under the Act of Income Tax. The government has been making the amendments to the act from time to time. So different time and the required, like yearly wise or whenever they required, they will make the changes in the act based on the changes what they required bring to the society. So Income Tax Rules 1962. The Income Tax Rules act as a supplement to the Income Tax Act of 1961. Income tax rules are the effective from 1st April 1962. The Central Board of Direct Taxes (CBDT) has the power to amend the income tax rules in India. So CBDT is the highest authority in India who has a power to amend the income tax rules in the country. And next, very important, Finance Act. What the Finance Act is? The Finance Act is an act which comes every year. So the Finance Minister of India, currently the Nirmala Sitharaman, the presents a finance bill every year that proposes the amendment to the direct tax and indirect taxes in the country. So for example, budget, you can take example of budget. In the budget, they will propose, the finance minister will propose the Finance Act of the country. So that when both the houses of the parliament passes the bill, upper house and lower house of the parliament with pass the bill, it receives the consent from the President of India and become the Finance Act of that year. And such amendments will become the part of the Income Tax Act and will be implemented from the first day of the next financial year. Usually, what is the first day of the next financial year? As we all know that is always start from 1st April of every year and end up to the 31st March of the every year. That is the financial year, we can call it as April to March. So the next very important, we'll go to the important definitions. Which are the important definitions in the income tax? One is assessment year, section 2, subsection 9. So assessment year means it is a period of 12 months starting from 1st April and ending on 31st March every year. See here, assessment year is different, financial year is different. So financial year is the financial year which we are currently dealing with our incomes. So always assessment year fall after the financial ends, or assessment year comes after our financial year ends. Okay, and previous year, section 3, the previous year is nothing but the financial year preceding the assessment year. Means previous will come before the assessment year comes. It is a period of in which the income is earned. When we earn the income, that year is called as the previous year, or it is also called as a financial year. So the next is exceptions to the previous year. What are the exceptions we can take under the previous year? We can give some exceptions in the previous year. See, in case of a non-resident shipping company, section 172. See, non-resident shipping companies means what? We can't consider them as a previous year, whole year as a previous year. The shipping companies will be a non-resident, will become a non-resident. So at that time we can't consider them as a previous year. And in case of a person living India, section 174, when the person living India, he is traveling abroad, means he will permanently living India and he will go outside. At that time we can't consider as a previous year. When he is leaving India, during that year itself, whatever the income he earned in the for example from 1st April to he will stay here till 1st September. So that much duration we can calculate the income what he earned, and he has to pay the tax. That can be considered like that. And in case of a person who are likely to transfer the assets to avoid the tax, section 175. Suppose for example, X person want to transfer his assets to his daughter Y. So at the time, in the middle of the financial year, if you're transferring the assets, then till the time whatever he earned, that has to be filed, and then he has to transfer the assets to his daughter, like that the situation. So in case of a discontinued business, when the business is discontinued, we can't wait until the financial year end. The business is discontinuing, up to that day how much you earned, if it is come under the tax slab, you have to pay the tax up to that amount. So these are the different exceptions to the previous year we can consider. Okay, depending on the situation, it's going to be applicable. The next is a assessee, section 2 subsection 7. Who is an assessee? An assessee means a person by whom any tax or any other sum is payable under the Income Tax Act of 1961. So any sort of tax you are going to pay, you are come under the purview of the income tax, then they call you as a assessee. Okay, is a person who pays the tax to the government. Next, deemed assessee. Deemed assessee means he is considered as an assessee, deemed to be assumed as an assessee. So deemed assessee is a person who pays a tax on behalf of another person. So directly he is not paying the tax, but he is paying the tax on behalf of another person. Take for example a father paying the tax on behalf of his minor child. Suppose for example child actors, the people who will play the sports in their childhood only, they will earn some money. So when they earn some money, at that time the minor child cannot file their tax on behalf on themselves. The father is paying the tax on behalf of their child. That's what the person is called, a deemed assessee, who pays the tax on behalf of the another. The next is a deemed assessee in default. Who considered as a deemed assessee in defaultly will become the deemed assessee, or assumed to be assessee. Suppose the deemed assessee in default means assessee has default to pay the tax. You take example like an employer has deducted the TDS, like an institution. Okay, institution has deducted the TDS of the employee A, so of the salaried person. So by oversight, it has default to remit the amount to the government. They should not keep that amount, they should remit to the government. So definitely they become the deemed assessee in default. And next is the person, section 2 subsection 31. The person has to be defined under section 2 subsection 31 of the Income Tax Act of 1961, which includes an individual person like us, a Hindu undivided family. So in India, we have a Hindu undivided families who are running the business till now. If you go to many places, there is a Hindu undivided family. Even family members are running the business. That is called a Hindu undivided family. And a company, it may be private limited or public limited company, a firm, okay, an association of person or a body of individual, whether incorporated or not, and a local authority like municipal and all. Every artificial judicial person not falling within or of the preceding subclasses. So all these are comes as a person. So in income tax, all we call them as a person only. Okay. Next, gross total income. What the gross total income is? See, gross total income is the aggregate of all 5 heads of income. Section 14 deals with the gross total income, and it includes. See, in income tax, we have a 5 heads of income. What are those 5 heads of income? In that, one is the income from salary. The person who is working as an employee, he will earn the salary from the employer. And income from house property. The person who let out the building for rent, owner, he is assessee, he earned the rent from the tenant, so that is the income from house property. Next, profits and gains of business or profession. The person who runs the business, okay, so he will earn the money from the business, that is the profits or gains from the business. And coming to the profession, take example like doctor, lawyer, chartered accountant, they will practice their profession. Whatever they earn, like consultation fee, okay, all this they will earn, that is called as a professional income. And income from capital gains. So different types of capital gains people will earn, like short-term capital gain, long-term capital gain, investment in different kinds of properties. They will buy, sell, all these things they will do, investment in the market. So all these things are the capital gain. That is also one of the head of the income tax. And lastly, income from other sources. So which are the incomes which are not fall under the above 4 head, and that will fall under the income from other sources. Take for example, billing from lotteries, crossword puzzles, horse race, all these things are comes under the income from other sources. Okay, these are the 5 head of income. When you calculate all the head of income which earned by a person, that is called as a gross total income. Okay, without giving any deduction. It means a person can only earn salary, a person can earn all the 5 head of income. The chances are there. Suppose for example, if X person is earning a salary, he may not be, he or may not be earn the income from other sources. He may invest in market, he may earn money, he may have a house property, he may let out. So the chances are there. Okay, he may run a business, side business, chances are there. Okay, any sort of income he can earn. It need not be in one head. It can be 5 head or it can be from 3 heads. Next, total income. What do you mean by total income? Total income means the total amount of income referred to in section 5 computed in the manner laid down in the act. All the deductions under section 80C to 80U made from the gross total income given the result amounted called as a total income. Means the 80C to 80U will applicable only in the old regime. When it comes to the deduction total income, whatever the income you earned is called as a gross total income, and after giving the applicable deductions under old regime or under the new regime, new tax regime, after that they will get one income that is called as a total income. Okay. So next, cess. What do you mean by cess? So coming to the cess, cess is a tax on tax collected for a specific purpose. So in India, government of India will impose some cess to cope up some expenditures and to reach some requirements of the public. So for example, education cess collected has to be spent on education, and every taxpayer who has to pay the income tax is liable to pay the cess at a rate of 4%. The central government has introduced the various cess, including the education cess on income tax that will be spent on the education. The current rate is 4%. Earlier it was called as health and education cess. Now it is just called as a cess. They are collecting 4% on the income tax, not on the income. That is on the income tax. How much tax you need to pay, on that you need to pay the cess. Okay. Next, surcharge. Surcharge is different, cess is different. Surcharge will be paid only by the high net worth individuals who earn more income. Suppose, say for example, 50 lakhs and above. If your income is 50 lakhs and above, then you have to pay the surcharge extra. Okay, surcharge is a tax on tax and not levied for any particular purpose. It is not for any particular purpose. The revenue earned from the surcharge can be spent in a way that deemed fit by the union government. Government can decide where we need to spend that money. To simplify, a surcharge on income tax is an extra tax to be paid by the taxpayer earning the higher income, that is beyond the certain limit. If you cross that limit, then only surcharge will come. Surcharge will not come to every taxpayer. It will come only to the high net worth individuals who earn more amount and those who need to pay the surcharge. And I'm coming to the end at the expected MCQ questions. As I told in the beginning, I'll give you some expected MCQ questions. What are those questions? Okay. So coming to this, the first question is, I've just given the right answer. Tax was introduced by whom in India? Okay, so that is the answer is Sir James Wilson, first time. And the Income Tax Act came into force on 1st April 1962. Income Tax Act came into force on 1st April 1962. Okay, Canons of Taxation is put forth by or introduced by Adam Smith, father of economics. And Income Tax Act of which year? The Income Tax Act came into force on which year, means which was introduced in which year, that is 1961. Don't get confused about income tax introduced and act year and income tax came into force. Okay, both are different. Okay, so income tax came into force on 1st April 1962 and income tax act is 1961. Okay, and the Income Tax Act consisting of how many sections and schedules? It is consisting of 298 sections and 14 schedules. And next is, who is the highest authority in income tax in India? So it is nothing but Central Board of Direct Taxes, CBDT. The CBDT was constituted in 1964 under the Central Board of Revenue Act of 1963. So head office of CBDT is located in New Delhi. Okay. Next, who presents a finance bill? Finance Minister of India. Who is going to be on that time the finance minister? That finance minister has to present the finance bill every year based on their consideration with the budget and all. Okay, so these are the expected MCQ questions which you can expect on the topic which we discussed till now. Okay, next is the expected short and long answers questions when you're writing your degree exams or UG exams. You can consider like this. So differentiate between the direct tax and indirect tax. So as I discussed, and briefly discuss the principles or canons of taxation given by Adam Smith. Write a brief note on legal enactment governing the income tax in India and on Finance Act. You need to write a brief note. And any meaning and definitions of short answer questions like who is a person, what is gross total income, all these things can be asked in the examination. For example, 2 marks questions like that they may ask. These are the expected short and long answers questions we can expect in the examination, the topic which I discussed till now. Okay, so thank you for watching my video. Stay tuned to my YouTube channel and subscribe my channel for more updates like this in the Voice of Commerce regarding the commerce. Thank you all. Have a nice day.